Markets just collapsed today after being in the green for a decent amount of time, and then as of around 2 p.m., things just decided to take a massive tumble. This was mainly because of the fact that tomorrow, April 5th, we are getting the job numbers. And, well, the narrative, guys, has completely changed. Again, they've actually changed back to what they were back at like 2023, where good news is bad news and bad news is good news. So we're going to cover as to why markets fell today. And towards the end, we're going to take a look at what the fear and greed index is, because this came in as a massive surprise to me. So before we get started, make sure to like, subscribe, comment. Really does help it with the algorithm on YouTube as well as Rumble. Make sure to follow us next. And, well, guys, this is the first video that I'm making ever since creating the Discord. So we do have a Discord. The link is in the description below. So if you guys would like to follow us there, if you guys would like to join and, talk about, post your trades, post your options, etc., you can. Link is in the description below for that. It's open. Please try to stay cordial. If not, you will be kicked. And until we actually make it where there's like a paywall, for now it will remain open. So with that said, guys, let's get started with this video. So NASDAQ, S&P, Dow shed over 1% each as investors brace for non-farm payrolls report. U.S. stocks on Thursday erased their gains and ended deep in the negative territory after some cautious commentary from a slew of Federal Reserve speakers offset a boost provided by signs of cooling in the labor market. Market participants are also looking ahead to a key non-farm payroll report due Tuesday. NASDAQ retreated 1.4 to close at 16,050 after erased an advance of as much as 1.15%. So the NASDAQ was up positive 1.15 and it retreated down to a negative of 1.4. The benchmark S&P slipped to 1.23 to settle at 5,150. It had climbed as much as 0.82%. And lastly, the Dow fell 1.35% to include at 38,596 points. Markets had risen in the morning and throughout the midday following the release of two labor market indicators before the opening bell. Firstly, data from the Challenger Gray and Christmas showed the US-based employer announced 90,309 job cuts in March, an acceleration of 7% from February. And also on top of that, the number of Americans filing for initial jobless claims in the past week increased 221,000 compared to the consensus of 213,000. The readings pointed to some signs of cooling in what has been a highly stubborn labor market. Recent data has only reinforced that resilience, and coupled with sticky inflation, has complicated the Federal Reserve's plans to cut interest rates. However, comments from the federal speakers put equities under pressure from around 2 o'clock Eastern onward. Minneapolis Fed President Neil Kashkari, speaking at a virtual question and answer session, said that more progress in inflation was needed to be seen before cutting interest rates. He further cautioned that it was possible that the Fed may not deliver cuts if inflation stalled. Another one, President Loretta Mester, at an event also said that more evidence was needed that inflation was coming down. Additionally, Chicago Fed President Austin Goolsbee echoed Mester and Kashkari's messaging and said that policymakers want to be more confident that inflation was moving down towards 2%. So you guys have here the inverse of what we've been hearing for the past few months, ever since the beginning of 2024, where the market was essentially going up with high labor numbers because of the fact that, well, inflation was going down. However, now they're saying the quiet part out loud, where inflation is remaining sticky, which is something that we have talked here on the channel to a lengthy extent, right? The whole thing that I've been saying since a few months ago was we have reached equilibrium when it comes to the inflation coming in and the interest rates coming out, essentially releasing the inflation. The amount of interest rates that we have are essentially enough to keep inflation at where it's currently at. And if we take a look at this, the CPI year over year is at 3.2. The CPI month over month is at 0.4. The core CPI year over year is at 3.8. And the core CPI month over month is also at 0.4. And this is what I've been saying. The inflation, guys, is going to stay around for around 6 to 9 months because the interest rates that we have are enough to keep it at this point. If we want inflation to go down to the 2% target that the Fed wants, you would need at least 1 to 2 more interest rate hikes at around 0.25%, right? 0.25% or 25 basis points. Either 1 or 2 of them would work fine, and then that would essentially put you at 2% or maybe just a little bit below of 2%. But unfortunately, this would mean that we get 1 or 2 more interest rate hikes, and that will send the market into turmoil. So once again, we have reached this conundrum where now the narrative when it comes to inflation is it's remaining sticky. It is no longer that it's going to go down or that it has gone down. It is now that it's remaining sticky at around this 4%, at least on the core CPI. And this will have a lot to do, guys, when it comes to the non-farm payrolls tomorrow. As you guys can see over here, they're expecting 212,000 and previous it was 275,000. If this thing comes in above 212,000, markets will most likely fall, seeing that the narrative has now switched back to what it was back in the day. If this thing comes in below 212, markets will probably rally. And if this thing shoots up even above 275,000, markets will probably crash and burn. So this might find itself, guys, a great buying opportunity to buy into the S&P 500 and many of the stocks that are massively overvalued. Will this happen? I don't necessarily know. By the time you guys see this video, it'll already come out. I'm going to actually release this video, guys, at 9 a.m. All right, so 30 minutes right after the non-farm payrolls come out, and then you'll probably know how futures are moving. But even then, even at open, it could change drastically too. So that's the reason why, guys, markets fell today. We'll see what happens. It's very interesting, though, that now the Fed is also saying that, yeah, inflation's stalling. Inflation is stalling. Even though Jerome Powell came out in the interview saying that, no, GDP is strong and the economy is strong. Yeah, sure it is. And inflation is heading down to 2%. Now Fed members are saying, no, it's not. It is absolutely not. And we will hold interest rates at this point for longer. The thing is that I personally think that we're not going to get inflation to go down until they raise it 1 or 2 more times to a rate around 6%, which would essentially make the retail rate at around 9-10%. So that's where we're essentially heading. And then on top of that, we're also getting a possibility of a massive rise in oil prices due to the fact that supply, it is dwindling and dwindling fast. But that's all I wanted to talk about, guys, when it comes to this video. We're going to end it with, of course, the fear and greed index, where the needle, it is no longer broken. The needle is actually in neutral right now, which is kind of surprising. However, on the previous close, we were at 64, still greed. On the 1 week, we were still greed. And then on the 1 month, we're still at extreme greed. Only as of 1 year ago, we went back to the neutral. So yeah, this thing is finally back to the neutral. I didn't see this coming in the slightest, but it is interesting the fact that the needle is no longer broken. We'll see what happens after tomorrow. This could either be at extreme fear or at extreme greed once again. But anyways, guys, that pretty much does it for this video. Make sure to like, subscribe, comment. It really does help over the algorithm on YouTube as well as Rumble. It really does help, guys, if you were to also share the stream as well. Follow us on X, and if you would like to join the Discord, link is in the description below. So with that said, peace out, and we will see you all next time.